In the United States alone, there's an average of 10,000 people stepping into retirement every day, a number that will continue to grow over the next 20 years. With the constant shifts in the economy and the volatility of the stock market, many are concerned, specifically those quickly approaching retirement. For those that have worked and saved for many years, the concern is now about finding a way to make personal finances last throughout the span of their retirement years. To add to this concern, many are worried if their savings can keep up with inflation and if they'll be able to sufficiently address their health care needs. I'm here today with experts in the retirement planning process to specifically address the topics on the minds of so many Americans. These financial advisors specialize in working with individuals that have retired or are within 10 years of retirement. Radon Stancil is a certified financial planner and the author of Take Control of Your Retirement Plan, a book addressing the various aspects of retirement planning. Rick Parks is a certified retirement financial advisor and the host of the Financial Safari radio show on WZTK 101.1 FM. Together, Stancil and Parks have more than 45 years of financial advisory experience and co-own Diversified Estate Services and Retirement Investment Strategies, a registered investment advisor firm. So with so many people retiring or already in retirement, what should they be looking for when considering finding somebody to help them reach those goals?
Well, several things. One would be experience, and together we have 45 years experience in this field.
And the other is credentials. I'm a certified financial planner. Rick is a certified retirement financial advisor. And we think that's important, not because you have to have it. I mean, there's a lot of advisors that do not have those, and they're good advisors. But the difference is that we feel that it helps the client feel at ease, knowing that we are specialists in the area that we're in. And actually, that's the third area, is that we feel like that the advisors should be specialists in the area of whatever it is a client's looking for. So, for example, the individuals we work with are close to or already in retirement. So if that's your particular situation, you want someone who specializes with people in that area of life. There's a difference between accumulation and pulling money out of things. And all the planning that goes around that is completely different. So if we have those types of advisors that are specialists in our area, it's going to make our life a lot easier.
And that's what we get to, when we get to know the client, we find out what is their interest. Are they interested in accumulating years, or are they interested in income planning? And then we can plan the right way with them. Okay,
so you have to explain the difference to me between fiduciary and a broker and salesperson. What's the difference?
Yeah, that is a question that hardly anyone even knows to ask. A fiduciary is required by law to put the client's interest before their own interest. A broker is someone who, say, sells stocks for a commission, or mutual funds or bonds for a commission, or insurance products for a commission. And their requirement is based on suitability. They just have to prove that whatever it is that they're offering is suitable for the person, and it could be a broad-based suitability. People that are 60 and within 10 years of retirement. A fiduciary has to look individually and say, is the plan that I'm putting together, the recommendations I'm making, are they the best for the client? So a fiduciary is held to a much higher standard.
So they have to put the client's interest ahead of our own.
And that's a question that I didn't even know I should be asking.
Yeah, and most people don't. So we try to really explain. That's the position we've put ourselves in. It holds us to a high standard. When we make recommendations, we have to put the client's interest first, not just suitability.
Okay.
And we don't work for a brokerage house. That means we're independent. So we have fiduciary requirements and we're independent, and so that gives us a whole universe of solutions to solve their problems.
Okay, and that brings us to how exactly do financial advisors get paid, and why is it important to know that, how they get paid?
Well, again, the answer to why is whose interest are they going to be looking after. The first way they can get paid is a commission. So if there's a commission in the front end or back end, every time a trade takes place, then you'd have to ask, well, who are they working for, themselves or the client?
And the other two ways are fee only and fee based. Fee only means that you go see the advisor and they're going to either charge you an hourly rate or a percentage of the assets under management. Now, if there is anything that they ever recommend in a commission-based world, like, say, for instance, an insurance product, they're going to have to refer you out to another advisor who's going to help you with that particular product. A fee-based advisor is actually able to do both things. They can actually charge a fee and have that fiduciary standard, or if there is a need to use an insurance product or something that is commission-based, they can actually do that as well. We are fee-based. That allows us to offer multiple situations for our clients to help them. But we are still held to the fiduciary standard, which means any recommendation has to be the best for the client.
So if you're making commission, you still have that, the goal is to do the best for the client,
That's
not
correct.
to earn your commission.
Correct.
That's correct. And that way we can put their interest ahead of ours, and we can keep it all in-house. We don't have to refer it out.
So as you have a new client come into your office, what are the top 3 areas where you really want them to focus?
Well, the first area we want them to focus is to understand the difference between what they've probably done for 30 or 35 years while they worked, which was save money. And so they've saved really well, they've accumulated money, but now they've got to shift their thinking from saving to actually starting to pull that money out and spend it. And if you think about it, if you retire at, say, 65, you potentially have 25, 30 years or even more in retirement. So you've got to take whatever it is you've accumulated and make that last over your lifetime and make it also keep up with inflation.
And the next one is risk tolerance. And again, when we get to be 60, 65 years old, do we want more risk or less risk? Well, most people want less risk. They want more safety. They've worked their whole life to build these nice accounts, and they don't want to lose it to the downs of the market. So there's a rule out here that we like. It's a 100 rule. 100 minus your age would give you a number that you can have at risk and still deal with the downs and ups of the market. So a 65-year-old would have 35% at risk, 65% at no risk where principal is protected. There should be some emergency money in there and then some income planning money in there, and then they can deal with the ups and downs of the market no matter what happens. We plan for the worst and hope for the best. But that way they can get through and know they have an income for life.
And the third area is taxes. And when people are trying to figure out where am I going to pull my money from to have income, they may have money in an IRA or 401k, and everything that's coming out of that account is going to be taxable. And then they may have some money in a brokerage account that's not going to be taxable. So the question is, how much should they pull from this account or how much should they pull from that account? And that's going to regulate the amount of tax they pay. There's another big issue, and that is if they have money in particular places like IRA, 401k, how are they going to leave it to the next generation so that they don't get taxed so big?
There is so much volatility in the stock market. We've all heard about it. So what should somebody so close to retirement or already in retirement, what should they be considering?
Well, they should consider a part of their portfolio to be fixed and safe. And that's very important because we do want to hope for the best, but we want to plan for the worst. And that way, if the market does go down, and typically the market will have a bear market every 4.8 years. We just can't pinpoint when those are. It would be nice if we could. But they are coming. And so if we're within 10 or 15 years of retirement, we're going to see some of those. And we have to deal with them in a way that is going to protect our income for life.
And I think that's a really good point he just brought up about the bear market. A bear market is considered a bear market if the market has pulled back by 20% or more. And knowing that that is going to happen nearly every 5 years, if I retire at 65 again, that's multiple of those I have to live through. So I don't want my money that's going to produce income to have that much volatility. Now, does that mean that I need to be all out of the stock market? Absolutely not. I can have money in the stock market, especially if I'm looking at it more long term. But I need to make sure that I've got income that's going to be fixed and take care of all of my basic needs. And then I can go out and risk money.
Right now, there's a lot of information coming out from some very credible sources, the Government Accountability Office, Barron's, Wall Street Journal, recommending that people look into annuities. How should people be finding unbiased information about how to consider annuities?
That's a great question. And the reason why is because if you go back 20 years, the word annuity became almost this bad word. And the reason why is because a lot of people said, why would you go into an annuity and never go into a fixed annuity, because you could go and invest in your money in the stock market and you're going to make 15 and 20% rates of return. Well, we know that that environment has changed. 01, 02, 08, 09 really changed the environment of the way people think about the stock market, fixed type of accounts, period. And so now more and more people are looking into annuities, and one of the biggest reasons why is that the insurance world, through annuities, is really the only place that a person can go and get a secure income stream over their lifetime. And so the government's coming out and saying, hey, people need to consider an annuity so that they can have an income stream that's going to last their lifetime without having to worry if it's tied to the stock market and they're going to lose all their value.
And the knowledge of these annuities is very important because there's good ones and bad ones. We did not even like any of them essentially a dozen years ago. And the reason we didn't like them, there's only one way to get your money back out after you accumulated money, and that is to annuitize it, give the money back to the insurance company to have an income stream. And that part sounds pretty good, but when they can't change it, they can't flex it at all, and they will lose all money when they die. The money goes back to the insurance company. So that's not a good deal. So they came out with walkaway products now at the end of the period, like a CD, that you can just take your money and put it wherever you'd like. You can start and stop your income stream. And so it's time to look at these because we can't have a fixed income account from them that will last our lifetime. And where else can we go? We can't go to the bank. There's too low an interest rate. We really can't do it with the market because it's going up and down. We want a fixed income account. So there are two different main types of annuities. One is a variable and one is a fixed. The variable's in the market with all the risk and the fees, and typically some fairly high fees. And we hear about annuities with high fees, that would be the variable. The fixed has no market fees. And then there are fixed annuities that also index the market. And you're not in the market, you're indexing it, so you have no risk, and you have a floor where you're protected in down years, and you get all the market up years up to a cap or a spread. And that way we're getting market-like returns with safety of principal.
And I think, as we talk about these, a lot of times people go, wow, this just sounds confusing. And they wonder, can I even understand these things? I mean, that's one of the biggest areas that people say is that they're too complicated. And I will be the first to tell you, they are complicated if I'm just trying to go out and learn them all and I'm going to hear the good parts without hearing the bad parts. And so what Rick and I do a lot of is spending time with our clients, educating them about annuities, how they work, and this is way before we'd ever even make a recommendation. But what we want to know is that the person is making an educated decision. They understand the products. They understand whether or not it makes sense in their situation. By the way, we both have clients that do not have annuities at all, and we have some clients that love annuities and they've made a lot of sense. So it's not like we're going to recommend this all the time. We come back to the fact that we offer, anytime we offer advice, it's based on a fiduciary basis where we're saying it's in the client's best interest. And so that's a really big issue, to get education when it comes to annuities.
So annuities are no longer necessarily a bad word, but it requires an individualized, personalized approach, whether they're the right fit for you.
And we think from an advisor who is independent in fiduciary requirements.
What are the most important things that people should know about their own 401ks and IRAs?
Well, first of all, they're different in this way. A 401k is a company plan. The company owns it. You're just a beneficiary of it. An IRA is an individual retirement arrangement where the IRS code allows you to own that money yourself and control it. And not to mention, an IRA gives you many more options than your 401k. Some people have actually thought that the 401k gives them lower fees because it's a part of the company, and that's not the case. In most of the cases, the fees are high, if not higher, than if they were in their own IRA, controlling it themselves. In addition to all the options that you get in an IRA, it brings up a new subject, and that is the next generation. What most people don't realize is that if you inherit an IRA or a 401k, anyone other than a spouse, that they would have to take all that money, lump sum, as a distribution if they don't know about other options. And that means all that money is going to get added to their income that year. So just think about it. Let's say you inherited a $200,000, $300,000, $400,000 IRA, and all that is income. That means 40% or more is going to Uncle Sam in taxes. And so after 2002, there was a provision put in place that allows the beneficiaries, other than the spouse, to stretch that over their lifetime, taking little distributions, which means it's going to be a lot less on their tax bracket.
In our workshops, we have about 25, 28 people attending many times, and we'll ask the question, how many know about the stretch rule that was passed in 2002? We'll have one or two hands. Most people don't know about it, and even the ones that know about it probably don't know how to execute it correctly. If it's executed incorrectly, it's done. You can't go back and refix it with Uncle Sam. So this takes knowledge. It's all about the knowledge of how to do it, and that's what we do for people. And we find that that people see a huge difference in results. There might be $1, $2, $3, $4 million difference handed down to them in a very favorable way tax-wise. That'll mean so much because they're accumulating over their life. We can imagine taking a small amount over their life as it continues to grow makes a huge difference.
And what most people think when they hear about this is, well, I want to buy one of these stretch IRAs. It's not a product. What this is just understanding the IRS code. And so what we did, because this is nowhere else out there, we're the only ones we've ever heard of that's ever done this, we created an IRA estate planner. And I say we're the only ones. I say it that way because we started talking to estate planning attorneys, and we said, why is it that these people are paying these huge sums in taxes? Because, by the way, 9 out of 10 beneficiaries will not stretch their IRA for one reason and one reason only, and that is because they don't know about it.
Absolutely.
And so we created an IRA estate planner that walks the beneficiaries step by step exactly how to do this. And we'd say put it right next to your major documents like your will or your trust so that you understand exactly how to word it so that everything's going to get done properly and you can just leave a legacy that literally means $1 million or more in difference.
And a lot of beneficiaries don't know about this, but a lot of financial planners don't know about
That's
this.
right. I mean, if you're working with an advisor, the one that's helped you accumulate all of your money, they may have done a great job in the accumulation phase. But what they don't specialize in is in the retirement years of how to deal with these accounts for, again, estate planning issues.
Another question that comes up on 401k, should I roll my 401k to an IRA? In many cases, that's advisable. We have to talk to the person to see if it fits them. But think about a company plan gives maybe 10 or 15 choices of investments, and that's it. Would it be better in many cases to go to an individual retirement account where you could have thousands of choices, maybe less fees, and then take advantage of that tax law that Radon was talking about of the stretch, because a 401k cannot be stretched, but an IRA can be stretched. So anybody that's over 59 and a half could consider an in-service rollover or your old job. We want to ask the question, what should you do with that old 401k money? Well, that's what we specialize in.
And by the way, sometimes people want to know, is there any cost? Meaning, do I have to pay taxes when I move my 401k to an IRA? No. It's a completely tax-free move from a 401k to an IRA, and there's no fees to do it either. So there's really not a reason not to, except for one little tiny place in our life, and that's if you retired and you're between the ages of 55 and 59. There could be a reason why you might want to hold it in there, and I'll save that for another time. But there's a possible way that you might want to leave it in there.
Perfect place to end it, gentlemen. I've learned so much today. Rick Parks, Radon Stancil, thank you for joining us.
All right, thank you.